Okay, folks, so we're going to talk a little bit today about accounting. It's a difficult subject to make exciting, but I ask you to bear with me. Pay some close attention, if you would, to these slides. They will come in handy as you do your reporting on businesses. You've probably read about the Securities and Exchange Commission, the SEC. It's not the football conference. Securities and Exchange Commission regulates all companies, publicly traded companies, keeps track on them, polices them essentially, includes some private companies that have a lot of shareholders. And the job of the agency is to protect us, protect all investors. And their working theory is that information is power. The more disclosure that you have, the better off you are as an investor. So they police companies to make sure their disclosures are accurate and adequate, and they prosecute them in the event that they are not. A lot of companies publicly traded, so they have a big job of policing. These include domestic companies as well as foreign companies they don't really have stocks, they have ADRs. I think a couple of you have invested in ADRs, as a matter of fact, in your stock portfolios. They're essentially the equivalent of stocks, if you will, but they just happen to involve foreign companies. But there are thousands, in fact millions of documents that the SEC has to keep track of. Big job. And you really do need to file, to understand the filings that the SEC has from these companies. Filings on things such as their earnings reports, announcements of mergers, that kinds of thing. And you can find a wealth of material there, an absolute treasure trove of material in earnings statements and so on, much more than you think, and they go much beyond the numbers. Lots of places to find information on these companies. SEC.gov is very, very helpful. There is a bit of a delay in getting information from there. freeedgar.com is also very helpful, and the wizard site, it does cost you though. I think that the Free Edgar is a very useful site that you might want to check. The other thing, of course, the other place where you can get information about companies is in their own company websites, where they file their documents, where they file their earnings documents, usually at the same time as they file them with the SEC. 10K. This is the annual report. It's both the glossy and slick annual report as well as the data-filled report that the companies have. I hope you get a chance to review some annual reports for the companies that you're going to be paying attention to. Take a look at the stuff in the glossy material, which tends to be promotional, but take a much closer look at the legal papers, the area of the report that's called the 10K. That has lots and lots of numbers and lots of discussion that will be helpful to you in profiling companies. 10Q is similar to a 10K, except it's on a quarterly basis. I really don't know why they call the K annual. I don't know what it has to do with annual, but 10Q obviously you can remember because it is a quarterly report. And this includes the earnings of the company quarter by quarter. Again, a very valuable thing to keep track of. You'll get charts, you'll get all sorts of data and numbers about the companies, and it really is important to you understand what these numbers mean. So we have two types of documents, basically, that go into financial statements that are worth paying attention to. The income statement and the balance statement. Let's talk a little bit about the income statement. The income statement essentially is a measure of how much money is coming into the company and going out of the company. Reporters need to follow that, and then, of course, this is the net earnings. You see revenues, expenses, profits. All of these figures are going to be there. You will see the net income of the company, which is the bottom line, so to say. You have sales, and then you have net income. Those are the two important measures. Sometimes sales are called revenues, sometimes they're called sales, sometimes they're called net sales. And then the bottom line, of course, is the net income. Those are the two most important things. If you think of it in terms of a household, it's the amount of money that's coming into your house. It would be the gross sales or gross revenues. The amount of money that you make, the profit that you make after all of your expenses would be your net income. Same thing goes for a company. This is an example of an income statement. Wilmer's Widgets. Cost of goods sold is essentially the cost it takes to produce the goods that Wilma makes. Typically, if you have a negative number, it will be in parentheses. That is, it is a subtraction from the financial statement, so it's in parentheses. The sales are obviously positive, so you see those. If you walk through this statement a little bit, you see the gross profit. Then you will have operating expenses, then some depreciation expense. That's an accounting entry for the deteriorating value of equipment and plant and so on. Then you'll have operating income, maybe some other income, maybe they have some investment income or something on their monies in their treasuries. Then you have earnings before tax, interest and tax, an important measure actually. You have interest expense and taxes, and then you get down to the net earnings or the retained earnings. Retained earnings would be really the sort of bottom line there, but net earnings would be the kind of thing that you would mostly report on and see reported on. So we have a company here that has sales of $990,000 in 2009, and their net earnings are $515,500. That's basically their profit. We can see how profitable they are. They actually do make a fair amount of money. Again, to elaborate a little bit on each of these lines, top line is called sales, sometimes it's called revenue or net operating revenue. Basically says this is how much of goods the company sold. And what you want to do is you want to compare really all of the financial terms with the same financial terms for the prior period. If you're looking in the annual statement, you look at their 2008 results in this case versus 2009, see how much they went up or down. Oftentimes you will look at a quarterly statement in which you will look at the results for this quarter and for this quarter a year before. That's as opposed to looking sequentially quarter to quarter. You really want to compare to the quarter and the prior year, because there are all sorts of seasonal factors that come into play. Cost of goods sold, in other words, what it costs to make these products, and you can see whether that's going up or down. If you see a really sharp rise in cost of goods sold versus the increase in sales, that might be a concern for you. It's obviously not a good long-term strategy to have your cost of goods of sales going up faster than your sales are. You're going to eventually go broke if that continues. So companies do have to keep that in balance. Gross profit, again, that's typically before expenses. It's really a simple subtraction. Then we get into operating expenses, depreciation, which is, as I said, the decline in value of machines and equipment. Operating income, useful line. It's before taxes, before any interest that they might owe, etc. It's good to trace operating income at times because taxes tend to fluctuate. For most of your earnings reports, you're going to want to pay attention to the net income. But if you're evaluating the health of a company and their tax rate tends to bounce around a lot, operating income can be a useful measure as well. EBITDA, earnings minus expenses such as interest, taxes, depreciation, amortization. It's just an abbreviation. Oftentimes analysts will use EBITDA. They want to deal with debt and somehow measure the ability of a company to service its debt. EBITDA is useful for that. It is used in a lot of tech companies at this point, and you have to be somewhat suspicious of it because it's not the fullest possible picture. I think net income is probably more useful. Sometimes the analysts will compare EBITDA, and it's not a bad thing. You get a good, clean comparison that way, but net will tell you a lot of information that the investor wants to know. So income statement, as I said, as I suggested in the last example, companies sometimes get their income from areas other than just sales, right? They have money in the bank, it earns interest, that sort of thing, and then you get the subtraction to get the net income. Sometimes companies will lose money. There will be a net loss. It's not a good thing, but it's not at the end of the world if a company has a net loss. Sometimes it happens in a given quarter, there's going to be a net loss. It might change in the next quarter. It's not a positive thing, but it does happen that companies actually don't make money sometimes. If they're spending a great deal of money on investing in plant and equipment, for instance, they might take some quarters of net losses. Yeah. And we had, in this example, we have the figures in red. They're not going to be in red, actually, in the official documents. Earnings per share is a very important figure as well. Analysts follow this particularly, and we want to use diluted earnings per share when possible. What that does is it basically says there are X number of shares outstanding. The company earned Y. This equals Z per share, earnings per share. It is a useful figure, and it's something that you ought to include in the earnings reports. How much did the company make net income in terms of net income, and how much did they make in terms of earnings per share? The balance sheet. Okay, this is where you have all of the assets and liabilities of a company basically set off against one another. You have the assets on one side, the liabilities on one side. By accounting convention, the assets have to equal the liabilities, and they do divide these into three categories: current, fixed, and intangible. Liabilities are the company's debts. This is a good example of a typical balance sheet, or a nice theoretical balance sheet at any rate. You can see how much the company has in assets, and you can see how much it has in different categories of assets. Company has $10,000 worth of cash or cash equivalents. Companies don't really keep a lot of cash on hand. They do refer to cash, but they really have their money in other things. They might have them in CDs, they might have them in other investments. They're cash equivalents. They're things that they can readily convert to cash, but they're not necessarily cash. Accounts receivable is something that the customers owe a company. Okay, it's how much that we intend to receive. And inventory, it's the value of what they've got in their warehouses. This is the debt side of the balance sheet that we had looked at before. You can see their liabilities. And again, if you notice from the prior example, there will be equal figures at the bottom line. And the way you get the figures to balance, if you have a shortcoming or an excess, you will have shareholders' equity. Shareholders' equity is the difference between the liabilities and the debts. It's basically what's left over. It's called the shareholders' equity, kind of like the equity that you would have in a house if you owned it. And that's so that the bottom lines tend to be equal. Accounts payable, what they owe. Taxes payable, what they owe. Long-term bonds, if a company has issued debt, they borrowed money from the public, they will have long-term bonds shown as a liability on their balance sheet. And again, this is shareholders' equity, the book value of the company. It's how much you would get, and this is a good definition, how much you would get if the company sold off everything, went out of business, and paid the investors what was left. Again, it's the way that assets equal liabilities. So you want to take a look at things in the balance sheet. You want to study the income sheet. When you're assessing a company, you also want to look at the balance sheet. Have they had big changes in certain areas, and if so, why? Oftentimes there are footnotes to these balance sheets that will explain if they invested in some new plants or something of that kind. You want to pay attention to big changes in these areas. Cash flow statement. What is the company getting from its operations, investments, and so on? Is it generating positive cash flow? Or is there more money coming in than going out? If it's negative cash flow, then you have a concern. The company is bleeding money. You don't really want to do that as a manager. This is a pretty good example, again, of a cash flow statement. You might notice that dollar figures here are in thousands. Dollar figures here are in thousands. That's a fairly typical convention to do that. Call it as in thousands. You do want to compare cash flow at the end of the year from the end of the prior year. Again, year to year. If it's increased, it means that good things are happening. If it's decreasing, there could be a problem. Not necessarily, a terrible thing, but you should ask what the explanation is. Negative cash flow really should prompt a question, at least to management. And look at specific lines. Why did the cash flow go up or down? Are there some new stock issues? what do they do actually to influence the cash flow? These are questions that you probably do want to ask a public relations person for a company once you've studied the statements. Footnotes, very, very important. There's lots of stuff in the little footnotes that can be very, very revealing, and a company might actually be hiding things in there. So it's really wise to read them to tell you what's going on. So, quick study in accounting. The readings that you've got should supplement this a little bit. Come back and revisit this slideshow if you have any questions, and pop me a note if you have any questions. Thanks.